Former Treasury Secretary, as well as former Fed Chair Janet Yellen, is with us this morning, and we're thrilled to have her as we all try to make sense of what is going on around us. Secretary Yellen, thank you for joining us. Help us understand what you know or you think of, for example, some of the comments that were made both on Friday and then over the weekend as we try to make sense of which tariffs are on and which tariffs are off, rather. Do you know?
Well, I think it's just completely chaotic. I know a lot of relief was felt when we discovered on Friday night or Saturday that computers and phones, electronics would be exempt from the highest Chinese tariffs. But then we were told yesterday that that's just a temporary reprieve and that there will be further developments there. So really, things have been just chaotic. The reciprocal tariffs put on, then paused. Don't know what's going to happen next. This is really creating an environment in which households and businesses feel paralyzed by the uncertainty about what's going to happen. It makes planning almost impossible.
Have you gotten calls from any of your former counterparts that are either allies or enemies or others trying to understand what's going on? And I'm curious if you have what you tell them.
Well, I have had a few meetings, and the truth is I honestly don't know what to tell them because these are huge. I've said self-inflicted wound. To me, President Trump is taking a sledgehammer, not only that he's pounding our allies with this, but he's pounding the U.S. economy with this sledgehammer. And I don't understand the rationale for the tariffs. Most economists would say if what you're trying to do is to reduce the trade deficit, imposing tariffs is not going to be successful and is not the way to go about doing that. The best approach there would be greater fiscal discipline, which we're not likely to see. And perhaps it's to bring back American manufacturing. But I really think that's a pipe dream and not something that is likely to be accomplished. And we could even raise questions about whether or not, in a broad-based way, that's a desirable goal. And it's really hard to predict where this is going. The escalation with China could have very significant global implications.
Fair to say that the Biden administration did implement tariffs on China itself. So we should get back to that in just a moment. But I'm curious if you'd put your Fed hat back on, or at least your former Fed hat back on, and tell us what you saw in terms of the bond market last week and what you think of the bond market as a proxy for what's going on. How concerned are you about that? To the extent there are risks in the system, how do you see that playing out?
Well, we saw a very unusual pattern over the last couple of weeks in financial market developments. Normally, when times are chaotic and uncertainty is high, there's a desire to invest in safe assets, and that tends to push down U.S. Treasury yields. But U.S. Treasury yields went up. And when U.S. Treasury yields go up, normally that attracts capital inflows that would boost the dollar. But both the dollar declined and U.S. Treasury yields rose. And what that suggests is that investors are beginning to shun dollar-based assets, and that calling into question the safety of what is the bedrock of the global financial system, namely U.S. Treasuries. Now, I was pleased that the 10 and 30-year auctions went well. I don't think we're seeing dysfunction in the sense of liquidity completely drying up in the markets, but a pattern suggestive of a loss of confidence in U.S. economic policy and the safety of bedrock financial assets is really very worrisome.
Secretary Yellen, again, it's great to have you here. It's Kelly. I just have a question on that exact point. You were under some criticism for relying more on Treasury bills during your tenure, as we had some issues then with the amount of financing that had to be done. We are on equal, if not worse, footing now, and there are some rumors in the market. We're going to talk to Ed Yardeni and others about this next hour, that the Treasury Secretary, who came in and doubled down on your strategy, might actually have to further increase bill issuance. Do you think that that would be a sensible thing to do right now if it means the difference between kind of exploding long-end yields and costs to move even more in that direction on short-term bill issuance? What do you think the impact of that would be?
Well, you know, the U.S. Treasury has, for a very long period of time, followed a strategy when it comes to issuance of longer-term Treasury securities, of regular, predictable, orderly issuance. We don't try to play the markets, look at what's happening with yields along the curve, but announce a medium-term program of bond sales that the market understands. So I don't think that moving to bill issuance because you're disturbed that long rates have gone up would be a sensible financing strategy. Bill issuance did surge after the debt ceiling was resolved, and it really spiked. The reason for that is that the Treasury normally holds a cash balance of anywhere between $500 or $800 billion. And as the debt ceiling became more and more binding, that cash balance was run down to something very close to zero and had to be quickly rebuilt. And short-term treasuries and bills serve as a buffer. And so that's where the issuance initially was. But over time, the regular, orderly, and predictable issuance pattern would be bringing that down. So there was really no plan to massively increase bill issuance, and I don't think that would be wise.
Do you believe that either the Chinese could start dumping U.S. treasuries or just not buy them, and or there was some speculation last week it was actually the Japanese that were doing that? I mean, in terms of just a rational approach to this, there is an argument to say that if the Chinese were to do such a thing, they would be hurting themselves.
That would be my assessment, is that China, if they were to sell dollars, would be pushing up the value of their own currency and creating risks to the Treasury market and to global financial stability that would harm them and would represent a very significant escalation. So it's not something that I would expect China to do. I'm sure China hopes that we will be able to negotiate a bargain to, on both sides, reduce these extraordinary tariffs.
In terms of the quote-unquote art of the deal, who do you think has more leverage right now? There seems to be two arguments. One is that the United States is still the biggest economy in the world, the most important economy in the world, that everybody needs and wants to do business with the U.S., and therefore we have leverage over our allies and others. There's another perspective that over these next 90 days, that China may try to create its own alliances with the EU and other countries, effectively to ask things effectively of us, or at least make it harder for us to have leverage over them.
Well, I think the policies that the Trump administration are following, both with respect to unilateral imposition of tariffs and also our alliances, commitment to NATO, treatment of Ukraine, are really causing our allies to have severe doubts about the United States as a friend and reliable ally, and promises we've made, including through USMCA to Canada and Mexico, that the previous Trump administration negotiated. We're simply burning those agreements without consultation. So I really am worried about the United States becoming isolated, viewed as untrustworthy, and this creating an opportunity for China to work with some of our best allies, Japan, South Korea, others, to try to, and you know, that is a very substantial economic region.
Have you discussed any of this with Scott Bessent?
No, I have not.
I know there was a dinner that took place last week among a whole host of former Treasury Secretaries. I don't believe you were there, but I was curious if you, I know you had spoken to him early on when he first got the job. I didn't know if you had conversations with others inside the administration. If you haven't spoken to him, I was going to ask you whether you've talked to Jay Powell, because he's the other person that may have to make some decisions about how to treat all this. And I'm curious, if you put your Fed hat back on, sort of how you think the Fed should even think about this, which is to say, you know, there's a question mark about whether the Trump administration has a put or a floor on this market, whether they can take the tariffs away or what they can do. But on the other end, you know, if the Fed effectively tries to prop up the system, they effectively, therefore, are supporting these policies. And it's unclear whether, well, it's not even unclear. Jay Powell clearly doesn't like these policies.
Well, look, there's no put when it comes to the stock market ever with respect to the Fed, although if risks to financial stability arise, and let me be clear, I do not yet see those in play and hope they don't come into play, the Fed has a range of liquidity facilities that I would expect them to deploy as they did in March of 2020 after the pandemic. You know, I think that the tariff policies and the uncertainty they're creating create the most difficult possible situation for the Fed, because the Fed is going to focus squarely on its two congressionally mandated objectives, price stability and maximum employment. And inflation's come down. It's not quite at the Fed's target, but there's good reason to believe that we're going to see a surge in inflation, at least for a while. And
Madam
we've
Secretary,
seen in surveys.
Yeah, no, I was just
Yes.
going to say the definite, you know, last time it obviously was not transitory. It was deep-seated. It was maybe, I don't know, money supply, however you want to look at it, fiscal spending. That was the definition of not transitory when you called it transitory. This time, since it would be, you know, if the tariffs, if there wasn't a trade war, it's a one-time increase. So you don't, the second derivative isn't affected where inflation rises every year, not just one-time price. It just seems like this would be the definition of transitory, especially with oil prices coming down below $60. Well, I mean, this is a time to use the transitory word, not the last time.
Well, a lot of what happened the last time was also one shot, but the transitory suggests a matter of weeks and months, and it clearly wasn't that. And this time, it may be longer as well. The really key question has to do with inflation expectations and whether or not there can be second-round effects when prices go up. And I think they will go up very noticeably. Just think about autos. There's going to be sticker shock in auto showrooms quite soon, I believe, and many prices are likely to go up if these tariffs aren't unwound. We've seen in the most recent consumer surveys a jump in inflation expectations. Now, that is not necessarily meaningful. Households don't usually set prices, so it's not automatic that inflation expectations have moved up. but it's something the Fed will have to watch closely and worry about. So especially given the history we've had of inflation and not being quite back to normal, the Fed, I think, will be reluctant to cut rates. But recession probabilities have gone way up. I wouldn't want to go so far as to forecast a recession. But look, estimates suggest that the impact of these whole tariffs, if they stay where they are, on consumers could be in the region of $4,000. And that is a big hit to household income that can lead to less consumer spending on a wide range of goods. And the uncertainty that businesses face is likely to have a marked negative impact on investment spending. And a collapse in spending or a decline in consumer and business spending can really be responsible for significant recession.
We want to thank the former Treasury Secretary Janet Yellen for joining us this morning, offering her perspective, and we hope to talk again very, very soon as we watch all this play out. Thank you.